The loan didn't feel dangerous. It felt like relief, a button you could press and make a problem disappear. The bill was paid, the pressure eased, life moved on. And that's the trap, because loans don't hurt when you take them, they hurt later, quietly, in places you don't look at every day. Right now, this matters more than people admit. Household debt is rising again. Credit cards, personal loans, EMIs, buy now, pay later. On the surface, everything looks fine. Underneath, millions of people are borrowing just to keep today working. So why do loans feel helpful at first and dangerous later? Not emotionally, mechanically. Picture this. You're standing in a shallow pit, uncomfortable but survivable. Then someone drops a ladder and says, use this. Problem solved. That ladder is the loan. You climb out. You feel capable. You move on. But here's the part no one highlights. The ladder isn't free. Every step up adds weight you'll carry later. That's how loans really work. At the start, a loan doesn't feel like debt. It feels like time travel. You borrow from a version of yourself that hasn't complained yet. Future you doesn't get a vote. Now, slow it down. When you take a loan, 3 things happen immediately. First, pain is delayed. Second, the real cost is hidden. Third, your lifestyle quietly adjusts upward. That third part is the danger, because once your life adapts to borrowed money, going back feels like loss, even if nothing was taken from you. Say you earn $30,000 a month. You take a loan with a $3,000 EMI. At first, it feels small, 10%, manageable, but your real income is now $27,000. You just don't call it that. And here's the math most people ignore. Every EMI permanently reduces flexibility, not happiness, options. One late salary, one medical expense, one unexpected bill, and suddenly that small EMI feels heavy. Loans don't destroy people when things collapse. They do it when things are slightly off. This is where most people believe they're still in control. And this is exactly where debt traps quietly form. If you want to see this clearly for yourself, we built a free tool that shows how EMIs, income, and expenses actually interact. The link is in the description, cashluom.online. Check it before the math starts deciding for you. Now let's talk about interest, because this is where the illusion becomes expensive. Most people don't feel interest, they just accept the number. But interest isn't a fee, it's time charging rent. The longer a loan exists, the more of your future work it quietly claims. A credit card charging 36% a year sounds abstract. What it really means is simple. If you don't clear it fast, you're paying for the same purchase again and again with future income. You didn't buy the thing, you rented it from yourself. Here's the irony. The people who rely on loans the most are the least able to afford the time cost. High interest isn't punishment, it's pricing for risk. Lenders aren't betting on your success, they're protecting themselves from your instability. Now zoom out. Why does the system push loans so hard if they're so risky? Because loans keep spending alive without fixing income. That's the deal. Instead of higher wages, people get higher credit limits. Consumption continues. Growth looks healthy. No uncomfortable conversations until the pressure shows up. This is why loans feel helpful early and suffocating later. Credit expands. People buy homes, cars, upgrades. Everyone feels richer. Then rates rise. EMIs grow. Refinancing dries up. And suddenly the same loan that helped you breathe is now tightening your chest. Here's the second thing most people miss. Debt rarely explodes. It tightens. Savings stop growing. Emergency funds disappear. Credit cards fill gaps. Stress becomes routine. Nothing dramatic happens, which is why people stay stuck longer than they should. Now the contrast. The hype says loans are tools, neutral, smart if used right. That's half true. Loans are power tools, useful briefly, dangerous if left running. The reality is simple. Loans are safest when income is stable, predictable, and growing. They're dangerous when income is tight, uncertain, or already stretched. Guess which group gets marketed loans the hardest? That's not accidental. Zoom out even more. This isn't just personal. Governments borrow to delay cuts. Companies borrow to boost short-term profits. Households borrow to maintain lifestyles wages no longer support. Everyone is borrowing tomorrow at once, which raises an uncomfortable question. If everyone owes tomorrow, who pays?
This is why financial stress feels personal but isn't. You didn't suddenly become careless. You stepped into a system designed to make borrowing painless up front and costly later. The real danger of loans isn't debt, it's dependency. The moment survival requires borrowing, control quietly shifts. You're no longer using the system is using you. So sit with this. Loans feel helpful because they solve today. They feel dangerous because they own tomorrow. The real question isn't whether loans are good or bad. It's this: how much of your future are you already spending without realizing it yet? If this helped you see debt more clearly, subscribe to Cashluom. And if you want a free, practical way to take control, the link is in the description. Visit cashluom.online to plan, track, and reduce your debt.